Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ati Inc. Annual Report. Ati Inc. offers a diverse range of businesses and services that cater to various industries worldwide. At the core of its operations are two primary segments: high-performance materials and components, and advanced alloys and solutions. The company produces high-performance materials, including titanium-based alloys, nickel and cobalt-based alloys, superalloys, advanced powder alloys, and specialty materials. These materials come in various forms such as ingot, billet, bar, rod, wire, shapes, rectangles, seamless tubes, precision forgings, components, and machine parts. In addition to its material production, Ati Inc. also provides hot rolling conversion services for carbon steel products. The company offers a range of specialty alloys in various forms, including plate, sheet, and precision rolled strip products made from zirconium, nickel-based alloys, titanium, and other materials. Ati Inc.'s customer base spans multiple industries, including medical and specialty energy, aerospace and defense, construction and mining, transportation, oil and gas, automotive, food equipment and appliances, and mining markets. With its extensive range of products and services, Ati Inc. has established itself as a leading provider in the global market for specialty materials and complex components. Ati Inc.'s stock price has skyrocketed by 177.99% in the past year due to a combination of strong financial performance, robust demand in aerospace and defense markets, and positive analyst sentiment. The company's impressive fourth quarter and fiscal year 2025 results exceeded Wall Street's expectations, with adjusted earnings per share, EPS, beating consensus estimates and revenue meeting or slightly exceeding projections. Ati also provided optimistic guidance for fiscal year 2026, projecting strong profitability and annual sales growth. A significant portion of Ati's sales comes from the aerospace and defense market, which has demonstrated sustained demand for high-performance materials and components. This consistent demand is a primary driver of the company's growth and positive market sentiment. In addition to its financial performance, Ati's initiation of a share repurchase program and operational improvements have also contributed to its stock price surge. The company's commitment to returning capital to shareholders and its focus on profitability and efficient operations have further bolstered investor confidence. As a result, analyst upgrades and increased price targets have followed, with Ati's stock benefiting from positive analysis and bullish sentiment. Overall, the combination of strong financial performance, robust demand in key markets, and positive analyst sentiment has driven Ati Inc.'s stock price to skyrocket by 177.99% in the past year. Ati Inc. market capitalization of $22 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Ati Inc. holds a significant advantage in their industry. Ati Inc. trades at a higher price-to-earnings ratio of 56 times and a higher price-to-book ratio of 11.96 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be attributed to several key factors. On the positive side, the company has experienced an increase in sales of nickel products due to hedging arrangements with customers, resulting in a significant boost to revenue. Additionally, a decrease in raw material costs due to natural gas cost hedges has also contributed to revenue growth. However, there are also some negative drivers that have impacted revenue. The loss on sale of Birmingham and Dusseldorf operations has resulted in a decline in revenue, amounting to $5.1 million. Furthermore, non-operating retirement benefit expenses have also had a negative impact on revenue, ranging from $500,000 to $600,000. The company's segments have also experienced varying levels of growth or decline. The HPMC segment has seen an increase in total revenue, but international sales have declined. On the other hand, the AA&S segment has experienced significant growth in total revenue, with a slight decline in international sales. It is worth noting that restructuring and other charges have also had an impact on revenue. In 2025, these charges totaled $48.8 million, while in 2024 they were $22.1 million, and in 2023 they were $31.4 million. These charges include startup costs, transformation-related costs, and losses on sale of customer accounts receivable. Overall, the company's revenue growth or decline can be attributed to a combination of these factors, which have both positively and negatively impacted its financial performance. Net income trends. The company's net income has experienced fluctuations over the past 2 years. In FY 2023, it decreased by 10% from $367.8 million to $327.1 million. However, in FY 2025, it increased by 9.4% from $382.7 million to $418.6 million compared to FY 2024. The increase in net income in FY 2025 is a positive trend, indicating improved financial performance. Profit margin analysis. The company's profit margins have also undergone changes. The gross profit margin increased from 20.6% in FY 2024 to 22% in FY 2025, while the adjusted EBITDA as a percentage of sales rose by 200 basis points, from 16.7% to 18.7%. These improvements suggest that the company has become more efficient and effective in its operations. Reasons for changes. Despite these positive trends, there are indications that profit margins may have decreased due to various factors such as reduced prices, currency fluctuations, and lower-priced imports. However, the exact reasons for the changes in net income and profit margins remain unclear. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the company has consistently produced positive operating cash flow in recent years. Specifically, for fiscal years ended December 28, 2025, and December 29, 2024, the company generated $614.3 million and $407.2 million, respectively. This trend suggests that the company's operations are generating sufficient cash to support its business activities without relying on external financing sources. The company's debt level and interest expenses have undergone significant changes over the past year. Notably, the total debt has decreased by $150 million through debt repayment, indicating a reduction in financial obligations. Furthermore, the long-term debt, although showing a slight increase from $1,714.9 million to $1,718.3 million, still reflects a decrease in overall debt burden. The interest expenses have also seen a substantial decline. The data reveals that interest expense decreased by approximately $9 million in fiscal year 2025 compared to the previous year. This reduction is evident across various pages of the report, with interest expense decreasing from $108.2 million in 2024 to $98.6 million in 2025. The decrease in interest expenses is a positive indicator for the company's financial health, suggesting that it has successfully managed its debt and reduced its interest payments. The financial performance of the company was mixed across various segments and regions. On a positive note, the HPMC segment stood out with impressive growth in revenue and EBITDA. The segment's sales increased by 7% in fiscal year 2025 compared to the previous year, while its EBITDA rose by 25%. The aerospace and defense market also performed well, with sales growing by 14% in FY 2025. In terms of regions, the United States saw a revenue growth of 4.6%, while Canada and other regions experienced significant growth of 45.8% and 44.6%, respectively. On the other hand, the AA&S segment struggled, particularly in the medical sector, where revenue declined by 23%. European operations also performed poorly due to higher insurance costs and losses on the sale of certain facilities. The company's corporate segment incurred expenses primarily classified as selling and administrative expenses. Additionally, closed facilities posed a challenge with expenses related to legal matters, environmental, real estate, and other facility costs. Overall, while some segments and regions showed strong growth, others faced significant challenges that need to be addressed. Management is optimistic about the company's outlook, citing continued growth in the defense end market and increasing demand for specialty materials and products driven by clean energy needs and electrification. The company plans to tap into significant aerospace and defense demand for additively manufactured laser-powered bed fusion parts and will continue to develop and manufacture innovative new alloys. However, management is also concerned about volatility in raw material prices due to inflationary trends and changes in international trade policy, as well as potential loss of customers and remediation costs due to climate change and environmental issues. To mitigate these risks, the company is focusing on innovation, quality assurance, and reducing manufacturing costs while prioritizing environmental compliance and sustainability. In terms of strategy, management emphasizes the importance of innovation, quality assurance, and reducing manufacturing costs, while also committing to safety with a goal of zero injuries and prioritizing human capital management. The company's financial position remains strong, with $1.1 billion in total liquidity, and a focus on managing its capital structure through the ratio of net debt to adjusted EBITDA. Management is also taking steps to manage risk, including using derivatives and physical hedges to reduce exposure to energy price volatility and maintaining a strong financial position to comply with credit agreements. Overall, management's strategy focuses on driving growth while mitigating risks and prioritizing sustainability and safety. The company has made several significant acquisitions and divestitures in the year 2023. In terms of acquisitions, the company purchased group annuity contracts from Ati Annuity and Life Company and Ati Annuity and Life Assurance of New York on 3 separate occasions in October 2023. These purchases were aimed at transferring a portion of its U.S. qualified defined benefit pension plan obligations to these companies. The acquisitions are expected to provide the company with financial relief and stability as it transfers some of its pension plan obligations to more stable entities. The total value of these acquisitions is not specified in the provided text. In addition to the acquisitions, the company has also made several divestitures in 2023. One notable example is the termination of a joint venture with Russian-based VSMPOAVI SMA through Unity, LLC. This move was likely due to changing market conditions and regulatory requirements. The company has also sold non-core businesses previously reported in the HPMC segment for $26.8 million. Furthermore, it has sold property, plant, and equipment primarily for oil and gas rights for $11.1 million. These sales are expected to provide the company with a significant influx of cash, which can be used to invest in other areas or pay off debts. Lastly, the company has sold its precision rolled strip operations, resulting in the derecognition of $10 million of asset retirement obligations, AROs. This move is likely aimed at streamlining the company's operations and reducing its financial liabilities. Overall, these acquisitions and divestitures demonstrate the company's efforts to restructure its business and improve its financial position. The company has a history of paying dividends to its shareholders. According to the financial reports, in 2025, 2024, and 2023, the company paid out a total of $13.2 million, $16 million, and $16 million respectively. This indicates that the company has consistently distributed a portion of its profits to its shareholders. In addition to paying dividends, the company has also engaged in share buybacks. Between 2023 and 2025, the company purchased a total of 53,021 shares at an average price of $81.70 and $98.81 per share. The financial reports show that the company spent $470 million, $260 million, and $85.2 million on share buybacks in 2025, 2024, and 2023 respectively. That concludes the financial summary for Ati Inc. Feel free to comment below, and I will be happy to answer them when possible.